Welcome to Balentic Edge, conversations that matter in private markets. On this show, we explore the people, strategies, and ideas shaping private markets today, from GPs building tomorrow's funds to LPs allocating in a shifting landscape. This episode is brought to you by Orca, an AI-driven compliant platform connecting the right GPs with the right LPs, smarter matches, faster decisions, and better outcomes. There are moments in markets where it feels like something fundamental has shifted, but you can't quite define what yet. That's exactly the feeling captured in Hamilton Lane's latest market overview, titled Pandora's Box. And it's one of those pieces I personally make sure to read every year. It's thoughtful, data-rich, and, frankly, a bit long. So today, we're doing something slightly different. We're distilling it. Welcome to Balentic Edge, where private markets meet insight. I'm your host, Kasper, investor, entrepreneur, and founder of Balentic. If you're allocating capital today, whether you're an LP building a portfolio or a GP navigating fundraising, you're operating in a market defined by uncertainty, structural change, and some very real constraints. So in this episode, we're unpacking the essentials from Hamilton Lane's 2026 market overview, what actually matters, what's misunderstood, and what you should be paying attention to right now. And as always, I'm joined by Alex, our in-house private markets expert. Alex, great to have you back.
Thank you. Great to be back.
Let's start with the framing, because Hamilton Lane opens with this idea that we've effectively opened the box. What does that actually mean in a market context?
A surprisingly powerful metaphor. What they're really saying is, we're in a regime shift, but we don't yet know the outcome. And that uncertainty isn't just cyclical, it's structural. You've got geopolitics shifting, trade dynamics evolving, central bank credibility being questioned, and layered on top of that, AI, which might be the most disruptive force we've seen in decades.
So it's not just markets are uncertain. It's that the rules themselves might be changing.
Exactly. And the important nuance is this. Both optimism and pessimism can be justified at the same time. That's what makes this moment difficult for investors.
Let's make this practical. If you're an LP listening to this, you're probably asking, what are markets actually telling us right now?
And this is where it gets interesting, because the signals are contradictory. You've got strong equity markets, but at the same time, long-term interest rates remain stubbornly high. The dollar is weakening, and gold is surging.
Which typically signals lack of confidence?
Exactly. Gold doesn't rally in a world where everything is fine. So what markets are telling you is, yes, growth is holding up, but confidence in the system, particularly around currencies and debt sustainability, is weakening.
So we're in this strange environment where things look fine on the surface, but structurally something's off.
That's a good way to put it.
Now let's move to what is probably the central theme of the entire report, AI. Hamilton Lane basically says this is the only investment question that matters, and that's a bold statement.
It is, but it's not unreasonable. Their argument is simple. All the macro debates, rates, inflation, geopolitics, are secondary compared to the impact AI could have on productivity and growth.
So if you get AI right, you're directionally correct. If you get it wrong, everything else doesn't save you.
Exactly. And there are two key layers to this. First, concentration. Public markets are heavily exposed to a very small number of AI-driven companies. The Magnificent Seven are effectively driving returns. Second, private markets. That's where the broader ecosystem sits. Applications, infrastructure, emerging companies.
So public markets give you narrow exposure. Private markets give you breadth. But let's make that even more concrete for the listener, because this is where I think people get it wrong. If you own the S&P 500 today, you probably think you're diversified, but in reality, you're not.
Yeah, you've essentially become a venture capitalist. You're making this massive, unhedged bet on just 7 companies' ability to build a godlike AI.
Which is a slightly uncomfortable way to think about passive investing.
Right. And here's the uncomfortable truth. A lot of the value creation in AI is happening privately and may never fully reach public markets.
Let's address the obvious question. Is this a bubble?
Hamilton Lane's answer is nuanced. They don't dismiss the risks. There are real concerns: massive capital spending, unclear revenue models, some circular funding dynamics. But they still lean toward not calling it a bubble.
Why?
Because the capital is coming from strong balance sheets, and more importantly, The potential use cases are enormous. This isn't a niche technology. It could touch every sector.
So the takeaway isn't ignore the risk, this is probabilistic.
Exactly. They frame it almost like a coin flip, but slightly tilted toward upside, which means, as an investor, you need exposure, but you also need resilience if things don't play out as expected.
Let's shift gears to something much more tangible, distributions. Because this is the question LPs keep asking, where is the money?
And here's the paradox. Absolute distributions aren't terrible. In fact, 2025 was one of the largest years on record. But relative to the size of the market, they're weak.
Because the market has grown so much.
Exactly. And the real concern is timing. The 2020 to 2022 vintages represent about 40% of current NAV. If those funds don't start distributing meaningfully soon, it has knock-on effects for liquidity, commitment pacing, and overall portfolio construction.
So this isn't just a nice to have, it's structurally important.
It's critical, and the data shows that early distributions are strongly correlated with ultimate performance. That's the part LPs should be watching closely.
Let's zoom out for a second. If you connect all of this, AI concentration, weak distributions, macro uncertainty, what does it actually mean for LPs and GPs?
For LPs, portfolio construction becomes more deliberate. You need exposure to AI, but across the stack. Liquidity management, because distributions are slower. And probably a stronger focus on manager selection than ever before.
And for GPs?
3 things. 1. Adaptation. AI is not optional. Even if you're not investing in it directly, it will impact your portfolio companies. 2. Discipline. Exit timing is harder. Capital is more selective. And 3. Differentiation. Because fundraising is still constrained, and LPs are more selective.
Let's bring this together. If you're listening to this, here are the key takeaways. First, we are in a structural transition, not just a cyclical one. Second, AI is the defining investment theme, but exposure matters more than narrative. Third, public markets are concentrated. Private markets are where breadth sits. Fourth, distributions remain the critical pressure point in private markets today. And finally, this is a probabilistic environment. Portfolio construction needs to reflect that. So where does that leave us? Somewhere between optimism and uncertainty. We've opened the box, but we don't yet know what comes out. And for investors, that means one thing. You don't wait for clarity, you position for possibility. If you want to go deeper, I'd strongly recommend reading the full Hamilton Lane Market Overview. It's one of the most thoughtful pieces published each year in private markets. Alex, as always, thanks for the insights, and to everyone listening, if you found this useful, follow Balentic Edge and subscribe. Until next time, stay illiquid. Finally, a small but necessary disclaimer. The views and opinions expressed in this podcast are those of the individual speakers and guests, and do not necessarily reflect the views of Balentic or any affiliated entity. This podcast is provided for informational and educational purposes only. It does not constitute investment advice, legal advice, or any other form of professional advice, nor does it constitute an offer or solicitation to buy or sell any financial instrument, security, or investment strategy in any jurisdiction. Certain statements may be forward-looking in nature and are based on current expectations, assumptions, and beliefs. Actual outcomes may differ materially due to risks, uncertainties, and other factors. Listeners should seek independent professional advice before making any investment or financial decisions.